Hi, I'm Brooke Thackeray. Welcome to What's Hot and What's Not in the month of September. I'd like to change the format up for this monthly video. And I'd like to, instead of going back and taking a look at the historical performance of the sectors in the market over the last month, I want to jump right in and take a look at the sector seasonality and also to the broad market and talk about the implications. So let's jump right in and take a look at the S&P 500. Now, this is from my Thackeray's 2022 Investor's Guide that should be coming out later this year. This is the S&P 500 here on average from 1950 to 2020. You can see the average month here. It tends to end up being negative. Now, what I do want to point out is the first half of the month, or 2/3 of the month on average, tends to be fairly flat, a little bit volatile, and then we tend to see a little bit of a drop take place. Now, every year is different, of course. This is just an average, but we can see some volatility take place. Now, this might take place, it could take place perhaps after the options expiry partway through the month, the third Friday of September. Now, I want to say that over the last few months, we have seen the stock market, the S&P 500, rally after options expiry in towards a month end. Now, also too, we do see the Federal Reserve coming out with its FOMC not minutes, but the FOMC presentation after their meeting on September the 22nd. Investors will be looking for Powell to clarify some of his comments from the Jackson's Hole Economic Symposium, and that could perhaps also to either push the market higher, of course, or lower. But on a seasonal basis, we do see the tendency for the stock market to be a little bit soft in September, and particularly about 2/3 way through the month. In fact, if we take a look from 1950 to 2020 here for the S&P 500, it's the 12th best month of the year on average, which makes it the worst month of the year on average. It has only been positive 45% of the time, and has on average produced a negative loss of 0.5%. If we take a look at the sectors of the market here, we can see that the telecom sector on average from 1990 to 2020 has been the top performing sector. Now, these sectors, major sectors, are all ranked by their average gain. And there is a caveat with the telecom sector. You have to watch out because the telecom sector, or the communication services sector, has changed its format and structure quite substantially over the decades. Healthcare tends to also be a top performing sector in the month of September as well, as does the energy sector. The energy sector here at the top of, at the upper end of the pile here, or the list, but there's a warning here on that, in the fact that the energy sector 58% of the time has outperformed the S&P 500. But let's take a look at the month of October. And if you take a look at the month of October from 1990 to 2020, the energy sector is all the way down at the bottom of the list, only outperformed the S&P 500 35% of the time. So although we can see the energy sector actually do quite well in the month of September, it tends to be very volatile. And also we're heading into a weaker time for the energy sector on a seasonal basis. If we take a look at utilities, this is interesting because the utility sector does have, on average, a 0.1% gain. And if we take a look at it, only outperforms the S&P 500 at 39% of the time, despite having a better average gain. So what that means is that the utility sector, when it outperforms, it can outperform quite well. And when it underperforms, it can underperform. And that sounds a little bit forthright, but that's really what it's coming down to. Is it tends to be a large dispersion in returns for the sector. So when it does turn negative, it can go lower. And so if we see interest rates head higher, the utility sector could actually start to suffer quickly, and something to watch out for. Consumer staples is really, here we are around the middle of the pack, and with a slight loss of 0.1% overall on average, and only outperforming the S&P 500 55% of the time. But let's go forward to October once again and take a look at the consumer staples sector. In fact, it tends to be one of the top performing sectors for the stock market, with an average gain of 2.2% in October as well. And the industrial sector tends to be in the bottom half here on average as well, with a loss of 0.2%. on average. Financials, a loss of 0.5%. Consumer discretionary, a loss of 0.8%. And information technology also tends to be at 0.8% loss. Now, once again, here we are with the industrial sector, tends to underperform the S&P 500 on average, but yet on a frequency basis, it outperforms 60% of the time. So some large losses can pull this sector down in September. And it's also important to note, if we jump forward once again to the month of October, the information technology sector tends to be one of the top performing sectors in this month. In fact, in previous books, I've paired these two sectors up and I've called them the odd couple for the transition into the 6-month favorable period for stocks that tends to perform well, both the information technology and the consumer staples as well. And the material sector, I have to point this out here, the material sector, average loss of 1.7% in this time period, and only positive 20, or only outperforming the S&P 500 29% of the time. So definitely a shift downwards for the sector on a seasonal basis. There's a theme here, though, and that is that the cyclical sectors tend to underperform the stock market in the month of September. Now, they have been underperforming over the last few months, although we start to see a pickup in the month of August, and particularly towards the end of the month. So we need to see that sustained rally for the cyclical sectors for the stock market to continue higher. But on a seasonal basis, that does not bode well for them. If we take a look at gold here, gold tends to actually perform quite well in the month of September, average gain of 1.8%, and outperforming the S&P 500 61% of the time. If we pull up the chart of gold here, we can see that, let's just jump over here to gold. We can see that gold has actually had some... If we take a look here, we saw that bottom in March. Let's just change that. And also two bottoms in March, like a little mini double bottom here. And we have seen a rising. The bottom that happened in August is a little bit higher. So if we just draw that line that way, we're seeing some rising bottoms here, but we haven't seen enough of that trend to say that we can still see that gold actually do quite well from here, at least in the month of October. So right now, there are some favorable tendencies on a seasonal basis for gold, and also we can see it here. Gold's consolidating at this point. It's still in a strong seasonal period, and investors should be watching out for that. If we take a look at gold here in the month of October, you can see that gold is actually way down the list. In fact, I have to move this up here it only outperforms the S&P 500 26% of the time from 1990 to 2020. So although gold can do well in September, it tends to perform poorly in October. It finishes a strong seasonal period in early October, but it can finish early, and that's something to watch out for as well. If we take a look at other seasonal trends in the marketplace right now that are taking place, we can see here that the 10-year yield on the 10-year Treasury note. This is interesting because what we're seeing here is we're seeing this downward trend line broken. This is the yield on the 10-year Treasury note. We did see in August, we did see it move higher, and on Friday last week with the Jackson Hole Economic Summit, we did see the yield pull back a little bit, but still is up for the month of August, which is helping to drive a little bit of the cyclical performance recently that's been performing well, and also including the financial sector as well. But so the yield on the 10-year Treasury note tends to actually continue to head lower on a seasonal basis into October the 3rd. But we can see it start to fade away earlier than that. In fact, that's exactly what we've seen over the last few years. We've seen the yield actually start to deteriorate a little bit earlier than the end date for seasonal periods. So something to watch out for. Overall, for the month of September, what we see is the stock market in its worst average seasonal period or month. It doesn't mean the stock market will go down in the month of September. Now, last year we saw the stock market rising in the summer months from June, July, August, and in September we saw that fairly big correction for the stock market. But then the stock market to start to stabilize again and then to move higher. Now, I'm not going to say that's going to happen this year, but September tends to be the time for large corrections. Now, we have seen Jackson Hole economic symposium comments from the Federal Reserve in the past, over the last number of years, when they've made a dovish comment or leaked out that QE2 was going to be released or another program was going to be stepped up. It has to tend to support the market. Now, it's going to be interesting to see how long the dovish tone that Powell put out on Friday from the Jackson Hole Economics Symposium, to see how long it sustains the market. Because if it doesn't help to push the market much higher here, we could see the market pull back here a little bit, the S&P 500, despite setting all-time highs. And we could see the market pull back here in the month of September. On top of that, we are seeing some of the economic data that's coming in. I've done a few reports on this as well. We're starting to see it hook lower, whether it's the PMI or other economic data as well, the Empire State Manufacturing Index, the Philly Fed Index. There's quite a number of economic data that's showing that the rate of changes for growth is slowing. And so if we see more of those reports come out where the economic numbers are softer in the weak seasonal period for the stock market, and if the investors are still not hyped on from the dovish comments from Powell, we could see the market stumble in September. And the good news is, if the market does stumble in September, that could set up for a good buying opportunity to start legging in a little bit more on the beta side towards the end of September, which has happened over the last a couple times over the last number of years as well. So we could see a buying opportunity if we do see a substantial correction in the month of September. It's something that we'll have to wait and see as it perhaps unfolds coming up here from this point. Thank you very much for joining me today.